28. Janus Capital's Bill Gross making a strong case for the Fed to raise interest rates, and he's calling for the central bank to make the move now. Gross argues that keeping rates near zero puts retirements at risk. Joining us now is Sethi Financial CIO Rob Morgan. Rob, great to see you this morning. Thanks for joining us early. So what is Bill Gross's point here exactly on retirements at risk?
Well, I agree with him that the Fed does need to raise rates, but I disagree on the reasons. I think the Fed needs to raise rates from the standpoint of they need some ammo, they need some bullets to be able to fight the next recession, and that's the primary reason that I think they should raise rates. He identifies certain constituencies that are hurt by low rates, but I think the analogy here is low gas prices. Low gas prices hurt the oil industry as low interest rates hurt savers and insurance companies, but in general, low oil prices, low rates, they're a boon for the general public. So that's kind of my overall take on where we stand there with rates.
So, Dagen, I want to pull you into this conversation. So, I mean, he falls into the camp of a lot of people we've talked to right on this show, by the way, Ryan, who have said the Fed didn't raise rates, but they should have raised rates. And a lot of people leading up to the Fed's decision said they should raise rates. That didn't happen, of course, but Bill Gross taking a different angle to this.
I'm not always a fan of Bill Gross, but he is right about the people who have lost out are the people who were the safest, who were savers, who did not take on all this debt during the financial crisis, and they have gotten it stuck to them. Bigger issue is people need yield. Retirees, individual retirees need income from their investments, and you have seen a shift where they are reaching for yield and investing in securities. Right. Fixed types of fixed income. These master limited partnerships have been taken to the woodshed because they invest in energy. That's where people had put their money. And so because they were looking for yield, they were looking for income, and they got, again, whacked, which happened during the financial crisis.
So, Ryan, to Bill Gross's point and to Dagen's point, Bill Gross actually said zero, referring to zero interest rate policy, destroys existing business models such as life insurance companies, balance sheets, and pension funds. He's particularly worried about the pension funds, saying, do central bankers not observe that Detroit, Puerto Rico, and soon Chicago, Illinois cannot meet their promised liabilities?
Yeah, I mean, there's a huge increase in the number of baby boomers that are reaching retirement. So retirement savings and things like pensions are hugely important. But also the health of the stock market is hugely important because people have their 401ks, their retirement is in the stock market there. So, but it's a tough trade-off for the economy because, auto loans, home loans, these are things that are cheaper now because interest rates are lower. And so that gives more money for people to save, because they can save a couple $100 maybe on their mortgage payments each month, and that means they can put that away. So there's sort of a trade-off there, I think.
Right, and so he has some very direct advice for the Federal Reserve, saying get off zero and get off quick. Will 2% Fed funds harm corporate America that has already termed out its debt? A little. Will stock and bond prices go down? Most certainly. Near-term pain? Yes. Long-term gain? Almost certainly.
Well, for companies, though, I mean, we had a story in our paper the day before the Fed meeting last week with a lot of very prominent CEOs saying that they didn't think that raising rates was a good idea. I mean, companies will invest when they think they've got good ideas, but also, I mean, you've seen a big M&A boom in part because companies have good access to capital right now, and so they want to take advantage of that. So I don't know that it's necessarily it's harming company business models in the broader corporate sector.
Rob, last word to you.
I agree with Ryan. It's a real stretch to say that it's harming corporate business models. Back to Dagen's point about savers being hurt here. Well, they've been in this bind really since 2008. I mean, that's about as long as rates have been at zero. So I think net zero rates are a boon for the general public, as I mentioned before. Certain constituencies are hurt, but they are adjusting to that. But the Fed does need to raise rates to combat the next.
Dare I ask the cliche question? When will they, Rob Morgan? Are they going to raise interest rates in December, or is it going to be pushed out to 2016?
They are going to raise rates in December. Absolutely, Sandra.
All right. Rob Morgan, thank you.